All right, last video for this chapter. And then just one more chapter to go, which should be mostly another review chapter. It's, I don't know, I guess because we assume you learn not that much in its introduction class. It's like, we'll just go over everything again in the intermediate and just add a little spice in at the end kind of thing. So hopefully most of this has been review for you, or, maybe you forgot some of it and you're like, oh yeah, I did learn that at some point, and it comes back quickly. So anyways, optimal capital budget. All right, definition of an optimal capital budget. It says it's a set of projects that maximizes the value of the firm. Now, finance theory says that your optimal capital budget is that if you look at independent projects, this would mean all positive NPV projects that you pursue them. And if they're mutually exclusive, that means that you pursue the ones with the highest NPV. All right. And that if you do that, then, that is your optimal capital budget and you will maximize the value of the firm. That doesn't always happen. Sometimes, for various reasons, firms don't seek out their optimal capital budget. And there's two basic kind of issues or reasons why. The first one is what's called an increasing marginal cost of capital. Remember, marginal is like that last dollar of your taxes kind of thing. The last dollar of your income is taxed at like a higher rate, right? The marginal tax rate versus the average. Well, in this case, again, it's kind of the same thing, that as we increase our capital budget, that last, capital that we raise could become more expensive, which makes it more expensive for the entire firm, right? It's not like we can isolate that last dollar of capital that we raised that's more expensive. The firm has to bear it. And so, you can kind of think about this in your own life too, right? That if you don't have it yet, you probably will eventually, have credit cards. Like I actually have a bunch of credit cards over the years, because I've just, never closed them because I want my credit history to stay, the length to stay long. And I always use them to just get the 0% financing, paid off before the time period is up, and free money. As long as you can manage it and not be ridiculous with it, not view it as free money, then you're good. I've done this now for, I guess since I was 18, so for 17 and a half, almost 18 years. Birthday's in August. That I could get the, let's say I have $100,000 credit limit available to me right now. The first $20,000 will come cheap. Then if I try to go out and get another $20,000, okay, maybe that's okay. Then if I try to go get another 20 and another 20, eventually there may be you're becoming a little bit more risky there. Right? Your credit utilization's going up. We're going to charge you a higher rate this time. Well, the same thing can happen to a firm. That, let's say they want to pursue all these projects, but to do so, they have to go raise more and more money. Well, it's kind of like they can enter into a new zone, a new range, right? To where if you start racking up too much debt, they start looking at you going, you're getting a little risky, right? Your cost was 10% when you were nice, low risk and weren't using a lot of debt. But now it'll be 12 and then 14 and then 16%, right? That makes sense. That's a legitimate story. And it's not just debt that becomes more expensive, right? As your debt becomes more expensive, well, guess what happens to your equity? It also becomes more expensive. Because your new equity holders are going to look and say, wow, you're getting more risky. You could default on that debt. Yeah, we're going to need a higher, rate of return. And so, it's not even just for the cost of your debt. It's for the cost of your equity. It's for the cost of your money. And so firms have to keep this in mind. And what this can cause is that, let's say that a project that had a positive NPV when the capital budget was $10 million may end up having a negative NPV when the capital budget jumps up to, let's say, $30 million. right? Because you have to go out and raise all that extra money, and they're going to start hiking rates on you, basically. So it can turn positive NPV projects into negative NPV projects at these higher costs of capital. And the book has a little chart and everything, but I think you like that makes sense, right? We can buy that. Hopefully you're nodding your heads. I'm nodding mine because I just talk to myself and lecture to myself and teach to myself. It's going to be weird being in front of people again. Anyways, issue 2 is what's called capital rationing. I always tell students, think about the words you're using. Rationing is not a good word, right? Like, we were never alive for a time of rationing unless you want to count like PlayStations and iPhones. But rationing's not good, right? Whenever we ration, that means we don't get as much as we want. And so capital rationing is when you don't get as much money as you want on purpose. So capital rationing is something that firms purposefully do. All right, they purposely forego projects that are positive NPV. So it says a situation in which the firm limits its capital expenditures to an amount less than would be, that should say required, not acquired, to fund the optimal capital budget. They purposely limit the budget, which is like the exact opposite of what the optimal capital budget is supposed to be, right? Optimal capital budget says take all the positive NPV projects. I almost imagine it like, you can probably tell by now I get a lot of weird concepts in my head. Sitting at like a kitchen table, you know, like people used to like play with like jacks, where you would like throw the jacks and like bounce the ball or whatever and pick up the jack. I don't think I ever played jacks, but I imagine like just a bunch of like little pieces of paper or toys or whatever on the table. And that capital rationing, optimal capital budget would say take all the ones on the table that have a positive NPV, right? Or capital rationing says leave them on the table. Don't you take those. You can only take so many on purpose. And so there's a few, it's not something that you want to tell your shareholders necessarily either, because, I mean, you're basically telling them like you're literally leaving money on the table. Why do firms do this? Sometimes they are reluctant to issue new stock for a few reasons. You should have learned at some point, kind of, if not, you'll learn it now in your life, that issuing stock is expensive. It's not cheap. It is not cheap to issue stock. Flotation costs are expensive, right? Additionally, you can send out a signal that your stock is overvalued. That's not good. You don't want to whisper to the market that your stock is overvalued, right? Because you would never sell stock if you think it's undervalued, because that means you wouldn't get a fair price. But you would sell it if you think it's overvalued. You would also sell it, what signaling theory says, that if the firm is expecting losses, yeah, come on in, other shareholders, come take some of these losses, right? You never invite people into the good times. You don't sell stock when you're expecting like record-breaking profits. Why would you want to share record-breaking profits with more people? You only want to share losses with more people. In addition, you may have to reveal some information you don't want to through the disclosure process and the whole process of dealing with the SEC by selling new stock. So that may be one reason the firms do capital rationing, because basically if you're not going to sell stock, well, you're just left with debt, and there's only so much debt you can accrue before you start getting into risky territory. Second reason that firms may do this is a more practical one. They lack the non-monetary resources to do so. I always think back to a few years ago when like gas prices were like super high. I'm talking about like $4 or $5 high kind of thing. They were doing a lot of fracking, right? And it was like South Dakota or something, or North Dakota, that, you know, they were like begging people to come work at these like fracking locations, you know, because it was so profitable at the time because gas was so expensive, and they couldn't get the workers. So this whole idea of constraints to non-monetary resources, we're talking about things like engineers, managers, technical people, basically, doctors, whatever, that you just don't have like the capital, the human capital, right? It's one thing. I can make more machines. I can buy more equipment. I can't just make an engineer. And I maybe can't convince them to move to South Dakota. Yeah. So that's a very practical one that firms do face. I mean, it's not simple. Even small businesses deal with this. Like, you know if you've ever tried to hire someone, people are morons. Especially if you're trying to find like skilled labor, it's even worse. And I'm just talking about like as simple as like a construction firm or something. I've seen the companies my husband's worked for over the years. They have trouble finding skilled labor. Like, yeah, they get a lot of knuckleheads that come in that can't read a tape measure in construction, but actually finding skilled labor is very difficult. And so that could be a problem. Look right now what's going on with the labor shortage in the market. Or I know it's a wage shortage, not a labor shortage, but look what's going on right now. That businesses are having to not be open as much as they would like because they don't have the labor. It's a real thing. Third and final reason is what's called controlling estimation bias, meaning that we know managers are going to be overzealous about the projects they want to pursue, right? And every project is going to be the best and the greatest and the most wonderful project ever, and fund my project and not his project because mine is better. Well, one way to kind of tamp that down is to basically limit the amount of money they can spend. And that's not probably a very good tool to use for that, because again, you are leaving money on the table by doing so, possibly. But it is something that we do see practice. Either they capital ration or they set a really, really high WAC, a really, really high discount rate that is meant to, again, kind of offset some of that optimism that may be happening with your managers. So that is the 3 reasons we think the firms may pursue capital rationing, which finishes off our chapter. I'll post up some review questions. Like I said, there'll probably be 3 quizzes, and then I'll post up some problems, which for the exam, you'll just be responsible for knowing the 5 decision rules and how to calculate them. Chapter 13 will be capital budgeting again, but we'll look at estimating those cash flows.